Hello, welcome to Charting and Technical Analysis. My name is Peter Mueller and I have developed this video series on YouTube for people who would like to make better trading and investment decisions. You can watch these videos by simply going to YouTube and looking for Dr. Peter Mueller Charting, and you will have access to all of our trading tools videos. You can also subscribe to my YouTube channel and you will be notified whenever we have a new video segment about trading and charting and technical analysis. Today, in part 3 of our video series, we are talking about Japanese candlesticks. In this segment, we talk about candlesticks. You will learn the terms like high, low, open, close, doji, hammer, hanging man, shadow, three white soldiers, bullish and bearish patterns, and so forth. Now, when you look to the candlesticks, you see on the right hand side the typical view on the Yahoo charting website. We have a line chart which gives us for each data point the latest data point on a given day and connects it by a line. This is a typical line chart, and the other two lines are representing two exponential moving averages we can use for trading decisions, which we have shown you in the last two videos. Now when we go up here on the selection of the chart type and we select candle, we have the new view of the candlestick. Now, how do we read these candlesticks? Here you can see on the left hand side, when you use a version in a book, they have black and white charts, but if you have a colored version, most of the software showing you the candlesticks in green and red bars representing the up days. So in other words, when the closing price is higher than the opening price, this is represented in a green bar. And when the closing price is lower than the opening price, then it is a red bar. And you see here in black and white, the up version of a day is a white candlestick, and the down day is represented by a black candlestick. And you see also on this is called the so-called body, which shows you the price difference between the open and the close of a day. And then you have these small little shadows up and below, which represent the so-called shadow or wick. And this shows you the highest and the lowest point of the day. So whenever you see a candlestick, these are the 4 key points you have to know. You will know what the highest point during the day is, you will know what the lowest point during the day is, and what the day was, where the opening higher than the close or lower than the close, then it is represented in the color of the body. Now, when you go to YouTube and you look at it, there are some basic types of patterns. So you can have, the body can have a green shaven top, for example, so that you have, in essence, a body which doesn't have any shadow on the top. And let's have a look here. Here, for example, we have a shaven top here and a shaven bottom. For example, we see it here. And here we have a shaven bottom for this red one. And here we have a shaven top on this green bar. Here is another shaven top. And this formation, by the way, when you have a little top and a longer shadow, this is also called a hammer. Then there is a specific form which is called a doji. And here I've given a little example here, this little cross here. I'm just zooming into it for you that you can see it. Let's have a look here. And here you can see a doji. That means, representing to this, the opening price is the same as a closing price, and we had some volatility during the day on upwards and downwards. So during the day it had higher and lower price points. There are two specific dojis which you can find. The one type where the opening and the closing price is at the very top of the doji, which are called dragonfly dojis. And then when the opening and the closing price are at the very bottom, these are called gravestone dojis. Now, the candlesticks on their own, when you look at them, they tell you basically the story, what happened during a trading day. For example, let's zoom in and let's have a look here on the right hand side to this doji on the right hand side, which essentially says it had a starting price, an opening price, which was up here, and during the day it had a high volatility. It went down to this very low point, and at the closing date it closed here at the end. So you have this large red body indicating that the closing price was lower than the opening price. And we had some further volatility here showing you that little shadow on the bottom. Now, candlesticks are normally used by a lot of traders to make short-term decisions on trading. It is a use tool for day traders, for example. But it can also be used to make trading decisions longer term. And then it is not the candlestick on its own for one single time interval the important thing, but it is rather than the pattern in what they are. And here I have shown you six classic bullish candlestick patterns, essentially showing you turning points during a trading period when you had a period of declining values of the stock, and then it reversed into a bullish pattern. You have on the left hand side here first the so-called bullish hammer, meaning you have a downtrend, you have predominantly red candlesticks, and then you have the hammer, which is a green. First of all, it changed the color. You have a shaven top and you have a long shadow here, which is called a bullish hammer, and then it is followed by other green candlesticks, the majority of them, and it indicates an upward movement of the price of the stock or ETF. Generally speaking, when you look at the candlestick chart, when you look here right, when it's predominantly green, it goes up, and when it's predominantly red, it goes down. So the other pattern is the inverse bullish hammer. It has basically the same setup. You have declining candlesticks, you see it predominantly red color, and then you have a green one, and you have an inverted hammer, meaning you have a shaven bottom. You have a long shadow above the bottom of the first green candle, and it goes up. It's called an inverse bullish hammer. The third pattern is called an bullish engulfing. You have a downtrend, and then the first candlestick shows a larger body than the previous one, and it is a green instead of a red one. That means this green body totally covers the size of that red one. This is called bullish engulfing. And here on the right hand side, when it is followed by a following through, because you have here an engulfing pattern too, as you can see here, and when it is followed by two other green candlesticks, so three green candlesticks, three in a row, are called three white soldiers. And when there is a little gap in between them, meaning that the opening day of the last day is higher than the closing day as the previous one, this is creating a gap here, and then it is called a rising widow. Then the fifth pattern important, the fifth bullish pattern, is called bullish piercing line, which means you had a declining pattern, and the last long body of the candlestick is followed by a green candlestick, and the body, the closing price, is above the middle of the closing price of the previous day. This is called bullish piercing line. And then the last but not least for today is the bullish morning star. It starts with, it is in essence a bullish piercing line, and in between there is a third day, which is a small green candlestick at the bottom. When you take here to the left the bullish piercing, and you have one day in between with an up day, so a green candlestick. And here when you look at it, how does it look in a full scenario? Here you can see, for example, I have an inverse hammer down here on the left hand side. I just zoom into it and show it to you a little bit more here. And here you see you have an inverse hammer. You have this little green candlestick followed by a red one, and you see the next it was setting up an upward trend. Then here is an example of 3 white soldiers, as you can see, and it has even two gaps, which is a rising widow pattern. And you have another 3 white soldier pattern right next to it. Then you can see here a very classic engulfing pattern. You see the green bar is much bigger than the red one, and the body of the green totally covers the inside. It covers the entire candlestick of the red one. And when we go here a little bit more to the right, we have an example of the bullish piercing line. You see, it is not fully engulfing, but it covers, it is here on the left-hand side. You see, the green bar goes through more than 50% of the red bar of the body, setting up a bullish pattern on this side. And last but not least, when we see here, this is a bullish hammer. You can see the body, it has a shaven top here, and the shadow is on the bottom, setting up a bullish pattern. Now let's go to some bearish patterns. The 6 patterns I've selected here, which are the most frequently. The first one is called the so-called hanging man, which is you have a starting bullish pattern, and then you have a hammer, but it is in red and not in green, indicating you had a down day, and it is followed by further red candlesticks, which indicate a downward trend. The second pattern, very important, it is the bearish engulfing. It is the reverse of the other one. So you have a small body of green, an uptrend, and the last candlestick is in a green one followed by a red, and the big red candlestick fully engulfs the green one, indicating then a possible downtrend, as you can see it here. The third pattern is called a shooting star, which is an inverse hammer, but it is a red candlestick, indicating it is a down day. So following an uptrend, you have an inverse hammer in red, followed by 1 or 2 more red candlesticks, and is an indication of the downturn. And if you have 3 red candlesticks in a row, these are called 3 black crows, which is a reverse to the 3 white soldiers, what we had before on the bullish side. The fifth pattern here to remember is the dark cloud cover, which is a kind of an inverse piercing line scenario. So we have at the top, the last green candlestick is pretty large, has a pretty large body, followed by a large, big red body, but the down point is below the 50% line of the last green candlestick, from then followed by another red candlestick, and further expecting then a downtrend. And last but not least, the sixth pattern indicating a bearish trend is a so-called evening star. As you can see, is characterized by 3 candlesticks, a solid body up day, followed by almost a doji with a little red body here, followed by another large down day with a large red body. When you have this kind of formation, which is called an evening star. Now, how do these look like in the real world? And I have here taken a real example. The first one you see here, bearish engulfing. You see at the end of an uptrend, you have a green candlestick followed by a red candlestick, and the body of the red one is bigger, fully incorporating the size of the green one. And you can see here it is followed by a downtrend. Then on this side here you have a hanging man. You see here the red hammer, basically. The third candlestick then is followed by a downtrend. And then you have followed here the 3 black crows and the dark cloud cover in one formation here. The dark cloud cover are these little 3. It is green, red, green. More important, those 2 green ones indicating the end of the uptrend, followed by an engulfing big red candlestick. And this pattern of 3 or 4 is the dark cloud cover. And then we have 2 more following big red down days, which is 3 black crows. And here on the right hand side, when we look, we have another bearish engulfing example, a huge red candlestick following this green one on the top, indicating that we would expect a bearish trend, which actually happened here. And here we have a kind of a mini formation, very little, where we see an evening star, where we have the green, red, red formation. As you can see here, when you compare it to the right hand side, this is an evening star formation. So we have seen 6 bullish and 6 bearish patterns, and we have seen it in real-time charts how they actually look like. Now, these are very common patterns, and when you get used to it and you practice it, you will see they are an important tool. These are one of my 10 tools I'm using, trying to figure out when a trend is ending and when there is a turning point and when a new trend is happening. That is the main purpose of candlesticks, trying to get as close as possible to identify these turning points that you sell when you are at the end of a bullish trading pattern, or when you have a bearish market and it starts to reverse into bullish and you decide to buy some stock at the bottom, which you want to sell later, obviously at a high. Now, a few basic things at the end for the candlesticks. So the candlesticks, you always have to be careful and look what they mean. So if they represent, in this case, we had daily candlesticks. So each candlestick told you the story for a single day. It told you the highest point, the lowest point, and the opening and the close. And remember, when the closing is higher than the opening, it is a green bar, and if the closing is lower than the opening price, then it is a red bar, which is a down day. So the candlesticks, day traders, for example, they make 1-minute candlesticks or 5-minute candlesticks, and they are used then, for example, when they follow quickly, they follow 3 specific, when they are on minute candlesticks, they make 3-minute decisions when they have 3 rising stars or whatever kind of pattern, and they know it can change on the dime, they use it. I use it on a daily basis, and it is one of the tools I'm using to figure out turning points of trends. A single candlestick seldom says a lot. However, when you look at them in the context of the preceding ones, when you see certain patterns, then it becomes a very powerful instrument. Candlesticks, as I said, are used for short-term trading. And some traders use them exclusively, particularly for day trading. I use it as one of many tools. So this is it for today and candlesticks. In our next segment, we will talk about the Bollinger Band and how it can be used in combination with candlestick charts and moving averages. Thank you very much for watching, and please feel free to share this video with your friends.